What's up, everybody? Investing Club here. Today, I want to talk a little about the buy and hold strategy and why it's not always the best strategy to use when investing. So, when you make an investment, you need to be prudent and intelligent about it and take into account the valuation something's trading at and the growth potential for the future. Now, a lot of people live by the buy and hold strategy and they buy an index fund such as the S&P 500, which I have on this chart, and they keep buying and they hold. For a lot of people, this will work. I'm not saying that it won't work, but what I'm saying is that is a very inefficient way to invest your money if you want to maximize your returns over the long term. So what is this graph? The website I'm using right now is Fast Graphs. And the thing I love about this website is it paints a very clear picture of how the fundamentals of a stock, namely the earnings and how much money it makes, and how that affects the stock price. So most of the time, the stock price will follow the earnings. When the earnings go up, the price goes up, and vice versa. And so I want people to notice that there's periods of severe overvaluation and undervaluation on this graph. And when do you want to invest in something? Of course, when it's undervalued. So from this, we can see the normal PE ratio of the S&P 500 is around 18. So just using the simple average, we know when the S&P 500 is above an 18 PE ratio, we can assume it's overvalued. And where we are right now is a PE ratio of 20. So we're clearly overvalued right now. Now, I want to take you back to the last time we were this overvalued. We were more overvalued than this, actually, which was all the way back in 2000. You can see we have a PE ratio of 26. And for people that are, buy and hold investors or dollar cost average, they're buying up here. We can see what happens if you bought up here in, the end of 2000, when the market was at PE ratio of 25, and you held it all the way to 2012. And you can see if you held an index fund these 12 years, you would make, including dividends, you would make 1.4% a year. And this clearly shows why buy and hold isn't always a great strategy. Namely, it's not a great strategy when the market is overvalued. There's a lot of investors are sitting on cash right now, and there's so many people that are saying, why not just invest in an index fund? It goes up on average 6% a year. It's better than keeping your money in the bank. Well, the fact is, if you invested in 2000, you would have been better off having your money in a savings account for 10 years compared to holding it in the market, right? So if you invested $10,000 at this point, 12 years later, you would have $11,892, including dividends. And that's over 12 years. Let's say you invested in 2009, right around here, and we can go to the same spot, the end of 2012. And mind you, this is 3 years. The $10,000 you invested turns into $16,507. This isn't hard stuff, guys. This is pretty easy to understand. Don't invest in anything when it's overvalued. And in the stock market, it's overvalued right now. If you invest in an overvalued stock market, what do you see? Then over 10 years, you get nothing. Whereas if you invest in something when it's clearly undervalued, the total for this, you make 65% in 3 years, for an annual return of 15%. And what people might say to this is, well, you can't time the market. You can't pick tops and bottoms. And I agree that you can't pick tops and bottoms. No one can. But what you can do is tell if the market is overvalued or undervalued very simply by looking at this graph. If the stock market is over the blue line, it's overvalued. And if it's under the blue line or under the orange line especially, it's undervalued. It's as simple as that. Looking at colors on a graph and seeing where the line is. If we take a look at where we are now, we're at a PE ratio of 20. And historically, the PE ratio is 18. So the market is clearly overvalued right now. Now, could we return to 2000 levels where the PE ratio is 26 and, all the way up to 28, 29? We could. I don't know. The market could keep going up by all means. But what will inevitably happen is the price will revert back to its long-term average PE ratio, which always happens no matter what people say. So right now, if you're an index fund investor, don't invest in an index fund. Just wait. There's other investments out there. You can hold cash, which I think is the best thing right now. You can buy bonds, even though interest rates are at an all-time low right now. Although prices of bonds could go up if interest rates keep getting lowered. And so seeing this graph and where we are right now just makes it painfully obvious that we're overvalued. and overdue for a correction. And I'm not an index investor. I believe that anyone can earn better returns than the market average by picking their own stocks if they know what they're doing, right? But if you only invest in index funds, now is not the best time to do it. Now, there's also going to be people that say they dollar cost average. And personally, I don't think dollar cost averaging is a good idea because, again, 2000 to 2001, let's say you dollar cost average $500 a month into an index fund, right? So let's say from the beginning of 2000 all the way to the end of 2001. So that's $500 a month. So that's $12,000 over 2 years that you're going to put in. Now, what is that $12,000 doing? Well, I'll tell you right now, for the next 10 years, it's doing absolutely nothing. Right, I just showed you that. If you invest here and you go all the way to 2012, you make 1% a year. You're better off holding your money in a savings account. Now, instead of dollar cost averaging, all you need to do is look at this graph and say, okay, I'm going to wait until the stock market is under the normal PE ratio of 18, and if it ever gets under 15, I'm going to start dumping money into it. That is a much smarter idea. So right here it's under the blue line. You could start investing here where the price is around 1300, and then when the stock market drops all the way down here and it gets around 1,000, even gets down to $730, you start dumping money into it. So let's say you invest right here at $919, $10,000, and stay to where we are right now. And look what happens. Your $10,000 becomes $41,315 with the dividends included, and that's for a 14.3% annual return. I mean, it's a no-brainer, guys, just looking at this. The 12 years from 2000 to 2012 making 1%, or from 2009 to 2020 you're making 14%. You're not going to be able to retire making 1% a year for 12 years. That's just not that's not going to grow your money. So if you want to invest in an index fund, I'm not saying you can't. I'm saying you have to be smart about it. And being smart about index investing means not investing in it right now when it's at the highest valuation it's been the last 10 years. So if you don't want to invest in an index fund right now, what should you invest in? Well, I always say the same thing. You want to find individual companies that are trading at a steep discount to what they're truly worth, and buy those and wait until they return to their intrinsic value of what you estimate, and then you can look for other opportunities. There's plenty of these out there right now, even though the market is overvalued, and I will be sharing some of them in a future video. So keep an eye out for that. Be sure to like and subscribe, and I'll see you on the next video. Bye-bye.